gold prices. Typically every time Wall Street is slightly shaky, gold prices, they tend to bounce back. Global volatility has shot up. It's too early to use the word fear, but somewhere some degree of profit booking clearly is visible. What's interesting this time around is that global markets are falling simply because of profit booking. There is no reason, there is no big headwind, so to speak, which has really disturbed developed markets. So I think the story is very simple to understand. The current market setup is developed markets are taking it easy, emerging markets are bouncing back. It's not only in India, but other markets like Taiwan, Argentina, Brazil, and even Korea are bouncing back. So money is moving out of developed markets and it is really revisiting emerging markets as an asset class. So how should one read into the current sectoral rotation or market rotation within equities? Let's discuss all that and much more with William de Vijlder, Chief Investment Officer and Strategy Head with the BNP Paribas Investment Partners. William, good morning and thank you for joining us. First, walk us through the big churn which we are witnessing within equities as an asset class. The fact that developed markets are taking it easy, emerging markets are bouncing back, are you worried about this price trend?
Well, we have seen a sharp run-up in specific sectors, and that has triggered profit-taking if you look at the tech space. The positive development is that it has caused a rotation in the value-type stocks. That is a positive development because it really shows that investors are not fundamentally putting into question the merits of being invested in equities, and very clearly one should be invested in equities in the environment that we're in. But nevertheless, it also shows that it's a more difficult environment compared to previous years, and it has become more difficult because, well, the monetary environment is gradually changing. So that is causing what I would say more a kind of a risk-on, risk-off type of behavior again.
William, hi, morning. A significant part of the correction is led by the tech sector. Is this just the start of something much bigger? Valuations are said to be the most vulnerable when it comes to this sector.
Well, something that has gone up very strongly. You will see lots of inclinations then to take profit. I think what is important, though, if you look at the tech space and the fast-growing stocks in general, and you look at their price-earnings multiple, you compare that to the market multiple, that we have definitely not reached the extreme relative multiples that we were seeing, for instance, in 99. That's an important element. It's in a way a relief, of course, but at the same time it is quite obvious and quite logic to expect that when something has gone up very fast that there would be a wave of profit taking. I don't think there is any fundamental kind of putting into question these stocks. It's actually investors getting a bit more selective and also taking some money off the table after what has been a very good run.
So, William, what is your thought process on investing in emerging markets versus developed markets? 2013 was all about developed markets, and looking at the initial trends for 2014, looks like emerging markets are back in demand or back in favor.
The question on EM versus DM is a difficult one. Why? Because, first of all, EM has been underperforming structurally now for the past 3 years. What you also see is that in the very recent outperformance, one is actually struggling to find any global top-down macro factor which would underpin that outperformance. So, in my view, it is more related to a specific number of countries starting to do better than before, and if you then put that all together, it kind of morphs into a more top-down thematic, like is EM back, yes or no. If you look at specific countries, you will observe that they have been underpinned by different factors. China has been underpinned, the equity market, by hope that there will be more initiatives to stop the slowdown in the economy. India has been underpinned because of better macro data, but also because of the elections coming up. Indonesia is a bit the same story. Turkey has been doing well, and that has been the case in the run-up to the local elections at the end of March, has continued to do fine afterwards. Brazil is very much driven by expectations about what the elections are going to bring, and the market is in a way inversely related to the popularity ranking of the president. So when you put it all together, it's all very much country specific, and there's not yet a big macro theme out there. Now, that does not mean that it cannot develop into something more longer lasting. The key thing, though, is that earnings growth has been disappointing in the developed economies, but it has also been disappointing very significantly in the emerging economies if you look back for the past 12 months and even beyond that. So what is key is that we see evidence that the business cycle is stabilizing and emerging, and that would then pave the way for faster earnings growth, and that's going to be the key condition. So it's a difficult one. In summary, I think there's a lot of momentum there. There was a good opportunity for a big bounce. We've seen that Brazil has been the most staggering example, but now we need to see follow through in terms of the macro data and the earnings data.
William, $10 billion have flowed into Indian markets in 2014. Do you see this picking up more pace, more speed in going forward?
Well, India has become the darling of international investors, and it was the first country to become the darling, and now you have Indonesia also kind of benefiting from that renewed interest. If you look at India, I think a lot is going to depend on what is going to happen with the election outcome, and specifically then what is going to happen afterwards, because now it's very much built on hope. It's also built, of course, on the fact that the inflation has been now been addressed. I mean, one has to come to grips with inflation, that's fine. Current account deficit has shrunk, and there's also a view that the positive spiral which has been set in motion with the strengthening of the currency is also going to make it easier to see a decline in inflation. You have then better financial conditions with the money flowing in. That would pave the way for interest rates to go down, and that should boost growth. So you have a kind of a virtuous circle developing. I think importantly what you want to see is that after the elections that the type of economic policy which is put in place is going to support that market enthusiasm. So for the time being, I think it continues to be pretty well supported. I think the key question will come after the elections. But let's not forget that the broader picture with respect to emerging markets has also improved. And that means that countries which have addressed their issues, and India has really been the first one to address its issues already in the summer of last year, I would expect that these countries would continue to do well and would continue to benefit from foreign interests. So I would then, as a conclusion, expect that capital would continue to flow in.
William, the electoral juggernaut is underway in the Indian markets, and we've seen the electoral manifestos being released and no real surprises there. What is your overall strategy for India ahead and post-election results?
Well, the strategy is that elections play some role, but in terms of sector allocation or stock picking, they only play a very limited role. I think for foreign investors, elections are more important. For two reasons. One, it clearly creates a kind of a catalyst to look very closely at the market, and what we have seen in India but also in other markets is that in the run-up to the elections, any market that had been moving down actually started to stabilize because there was hope that things would actually improve after the elections. That brings me to my second point, that foreign investors will specifically look at what type of policy is going to be adopted after the elections. On our side, if you look at the way we manage our Indian equity portfolios out of Mumbai, we really look at it from what's happening in the economy and in the earnings cycle perspective. That is one side, and then the other point is very much driven by bottom-up considerations. So elections only play a very small role. It goes without saying that if post-elections we would see specific measures being taken to address issues which are related to the supply side of the economy, that would then change the equation, of course, but that we would first have to see for anything happening in that area.